subscribe now and press the bell icon. Never miss an update.
Okay, fine, then we'll get started. And yesterday we were doing, does anyone remember what kind of filing status we went through yesterday? Okay, Divyansh. Just give me one quick. It's like a,
Marriage filing jointly.
Okay, next. Sakshi. We cannot hear her. Is she saying something, or maybe Vanna? You guys can give another one.
Streamline filing.
It's a quick fire round. No, I'm talking about filing status. Okay, the one that Divyansh said was married filing jointly. What is the other one?
Am I audible, ma'am, now?
You're audible. Okay.
Yeah.
Go ahead.
Other one is married filing separately and qualifying widower.
Yeah.
Okay, just one answer. Okay, Sakshi, we need to give.
Oh, I thought it's same. Okay.
Yes, ma'am. Qualifying video.
Yes. Okay, qualifying widower. Anyone else remembers anything else? Any other status?
Single.
Good job. Is that you, Vanna?
Yes, ma'am.
Good. Okay, so now I think we have addressed majority of them except head of household. So that's where we we stopped yesterday, and so we'll continue with this status. Okay, you guys can all hear me well, right?
Yes, ma'am.
Okay. So head of household, again, this is a special status given to a person. As the name suggests, that person should be maintaining the household. So there has to be a dependent, okay, with that person. Then only the person can be called head. Otherwise, like who is he or she head of? So there has to be dependence. There have to be some qualified people who can be considered as dependent. It can be a child, it can be a relative. There are certain conditions who can be a qualified dependent. And there are certain more conditions that need to be fulfilled in order for us to go for head of household status. Okay, so let's go through that. An individual qualifies for HOH status if he or she satisfies conditions with respect to filing status, marital status, and maintenance, household maintenance. So the first condition is filing status. The individual may not file as a surviving spouse. Okay, so if surviving spouse, there is a separate category. We have already seen that. Now the next thing is marital status. The person can be married or person may not be married. That doesn't matter. Person can be married and person may have some dependents. So instead of going for married filing separately status, the person can elect head of household. Now, what is the difference? Why does the person want to go for head of household and not MFS? Because obviously there are better benefits, there are more standard deductions if they elect for HOH category. So generally the taxpayer must be unmarried, because if the taxpayer is married, there are different other status. But a married person may qualify if the conditions are below are satisfied. We will go through those conditions. An individual is not treated as married for HOH status if the spouse is a non-resident alien at any time during the year. So if the spouse is not a US person, then the individual cannot take HOH status. I mean, then they cannot be considered as married. Okay, so it got stuck. Okay, we'll go through what is considered to be household maintenance. How much does the individual should be paying in order to consider that the individual is maintaining the household? So what they say, what IRS says, is to maintain a household for federal filing purpose, individual must furnish more than 50% of the cost to run the household. Again, more than 50% of which cost? This can be again very subjective. One can go for luxurious vacations or go for like a, shopping and super, all branded shopping, all big bills, and then they may say that, okay, I'm maintaining the household. That doesn't count. So what IRS has given is here are two different lists. What can be considered as qualifying and what are non-qualifying. Qualifying expenditures, as we will see, those are the basic expenditure needed to maintain the household. Vacation is not basic. One can survive without vacation. One can, I mean, for that reason, you can also say that, education is basic. Yeah, that's true. But again, education can be given for free from public schools, or one can send their kids to the most expensive private schools and all. Okay, so again, that's very subjective. Clothing, obviously basic clothing is needed, but then again that's becomes subjective. One can go for a simple $10 shirt, or one can go for $100, $200 one. Again, that becomes very subjective. So we cannot say, oh, that I spend like $20,000 only on clothing, so my other expenses are less than 20,000, so I'm spending more than 50% to maintain household. No, that doesn't count, because that is not a required expense. So property tax, that's definitely required. If you are living in a house that you have bought, you have to pay property taxes. One has to pay rent, utilities, mortgage interest, any repairs, any property insurance, food consumed in home, not food consumed outside. Okay, so there could be grocery expenses or other regular, like food related expenses, and also those all will qualify for that 50% of the cost that we are looking at. Now, who is considered to be a qualifying person? So any person who is staying with the taxpayer for more than half of the taxable year, and that person can be a child or it can be a relative. So qualifying child, this is very commonly we see if people are going for married filing separately status, and if they have kids, maybe the kid is staying with mom or the kid is staying with dad, whatever. So this situation is very common, and we have few clients for whom we are filing HOH status because they have their dependents living with them, or it's quite possible they are not separated, but then they still have dependents. They're unmarried, or maybe they have passed that 2-year period of being a qualified widower, and after that they can claim HOH status. Or the person is having parents as the relative, or as a dependent. So in that case, the person doesn't need to be married, right? They can still have qualified dependents for whom he can claim HOH status. So the taxpayer must maintain a household that constitutes the principal place of abode for more than half of the taxable year. And these people should stay for more than half of the year with the taxpayer. We cannot say that my relative is staying somewhere else, but I am the one who is paying for all the expenses. That could be completely true. People do that, right? But for this purpose, we cannot claim them as a dependent. Why? Because again, that's too many ambiguities there, like what you're doing, not doing. Or you can even call your friend and say that, okay, I'll pay for all the expenses for my friend, but they don't live in my house. So what IRS is saying, if the person is truly dependent, at least for half of the year, that person should live with you in your own house. And there are certain exceptions to that. If they are your parents, they don't have to live in the same house, because then there is another relation that has been established, that they are the parents. And it's very common to, in US or maybe now in India as well, that parents are living separately. So they cannot, IRS is not, that becomes a bit unreasonable to say that they have to live in the same house. There are certain conditions given here. We'll just go over that. This is the exception that we looked into, that a dependent parent qualifies even if they do not live with the taxpayer. And if the qualifying child lives with the taxpayer, the child does not need to be a taxpayer dependent. Now, this is going to be a bit confusing. We will see this later. The child can be living with taxpayer, but maybe somebody else is claiming that child as a dependent, not the taxpayer. So this is adding a bit complexity. We will go through some of the examples below. Let's just go through this table quickly. So First scenario, if the person is a qualifying child, it could be a child or a grandchild, okay, or a stepchild or an adopted child, and that child is living with taxpayer for more than half of the year. Okay, this is the first condition. There has to be a child. The child is living with the taxpayer in the same house. If the child is single, okay, then this person can be claimed as a dependent. This person is considered to be a qualifying person. Okay, for the purpose of HOH status. And doesn't matter whether the taxpayer is claiming that person as a dependent or not. This is the same thing which we saw here, that the qualifying child lives with the taxpayer. The qualifying child need not be the taxpayer's dependent. So right now, what we are trying to do from this table, we just want to understand who is the person that can be considered as a qualified person for the purpose of claiming HOH status. And the basic condition that we see is that person has to live with the taxpayer. And the person, if this is a child, it can be single child, and that child can be considered as qualifying. If the child is married, when we are using the word child, doesn't mean that the child has to be like 10, 12, 13 years old only. The child could be like, it could be 23, 24, 30-year-old also. And they're married and they're also staying with the taxpayer. So those conditions are possible. If that person is married, and if the taxpayer can claim him or her as a dependent, maybe the son is, got married and the wife is also living with the daughter-in-law is also living with the taxpayer. Maybe both of them are full-time students, and that's why they can be considered as dependents. Quite possible. So then they would be considered as qualifying person. If they are married and the taxpayer cannot claim him or her as a dependent because they're filing their own return, they're having income in their names, so they cannot be claimed as dependent. In that case, they are not qualifying person. Or the child is not a qualifying person if the child is married. So this first part is about the child. Second part is about the parent. Relative who is the father or mother. The taxpayer can claim him or her as a dependent. It's a qualifying person. This condition, they are not saying that for 6 months the parents have to live with them. Okay, but they can still be considered as qualifying as long as they are dependent on the taxpayer. If the parents are having their own income, they are not considered to be dependent, they file their own tax returns and all, then they are not qualifying person, even though they may be living in the same household, even though the head of household person might be incurring expenses for them. Doesn't matter. Okay, we cannot claim them as dependents because they are having their own income and they cannot be claimed as dependent. Any other relative other than parents or child, it could be like grandparent, brother, sister, and all. So for them, it's very important that they live in the same house for more than half of the year. And they have to be related in a way which is being mentioned in the IRS code. Just by saying this is my cousin, you cannot claim that person as a dependent or as a qualified person. So there's certain immediate relationship that is being given by IRS. They have to fall into one of them. And they need to be a dependent. The taxpayer should be able to claim him or her as a dependent. That means nobody else is claiming that person as a dependent. So when you are claiming some person as a dependent, you are giving that social security to IRS, saying that, okay, my brother who's living with me is dependent on me, and I want to claim that person, and here is the social security of my brother. Now, my sister cannot come and say that, no, I'm also going to, claim the brother as my dependent. Only one person can claim as a dependent, because IRS will then send a notice saying that, okay, how come two people are claiming one person as a dependent? Why? Because they can match social security easily. So the taxpayer should be able to claim him or her as a dependent. That means the person should not have income, like a large amount of income that would not put them in the dependent category. And secondly, nobody else should be claiming that person as a dependent. In that case, that becomes a qualifying person. If that person did not live with the taxpayer, obviously this is completely ruled out, not a qualifying person. Or if that person is not related to the taxpayer in the way IRS is given, IRS is talking about certain relationship. If that person is not related that way, not a qualifying person. Okay. Or if that person cannot be claimed as a dependent because someone else is claiming, or the person is having his or her own income, then again we are not considering that person as a qualifying person for HOH status. Generally what we see is usually like the children are taken for the purpose of HOH as qualifying dependents, or parents can be taken. This is very rare, but again, if the conditions are satisfied, then it's allowed. Okay, so are we clear about this table? This is very important because if someone comes and says, a client comes to us and they'll say, well, I have my 2 or 3 cousins, they've all moved from India to US, I have to bear all their expense, can I claim them as my dependents? Or if the person is single, he's saying that, okay, I have dependents, can I go with HOH status because I'm actually paying out for their expenses? And that could very well be true. Maybe he can show us all the receipts and all that, see, I'm incurring all the expenses for them. But again, we have to look into those IRS conditions. Do they satisfy all of them? Then yes, we can claim. And why is it so important? Because the more people you claim as dependent, the more credits that IRS gives. There's a better tax advantage. So obviously it is in the benefit of the taxpayer. Okay, and what about a married individual? If a person is married, can they go with HOH status? So a married individual who lives with a dependent apart from the spouse will be considered unmarried. For the purpose of IRS, we can consider the person to be unmarried, doesn't have to be legally separated or legally have all papers in place to say that this, the marriage doesn't exist anymore. The person can still be married, but if they satisfy the conditions, like they don't have to they should not be staying together, okay, in the same house, then they can be considered as separate for this purpose, and one of the spouse can go with HOH status. So a married individual who lives with a dependent, so for HOH status, obviously there has to be a dependent. Otherwise, a single person cannot take it. It can qualify for HOH status if for the tax year the individual files separately. There has the married filing separately. They cannot file jointly, obviously, right? I mean, if they're going for jointly, then they have to go with MFJ status. The individual is paying more than 50% towards maintaining the household. Spouse is not a member. The other spouse should not be living for more than 6 months in the same house. And we have to, when we are talking about 6 months, we have to take last 6 months of the year. Okay, so we are talking about like from July to December, because for individuals, the year end is always December. So it should not happen that, okay, first 6 months, the spouse is saying, they're living apart, then they come together, live in the same house, and until December 31st, they're living in the same house. But then during 12-month period, they can say that for 6 months we were living separately, but that does not count, because this word is important, last 6 months. And the household is the principal home of the qualified person. Any qualified dependent that we are talking about, it should be the principal home. The person who wants to claim HOH status, that person's home should be the principal home. And that person should be paying more than 50% towards maintaining the household. okay, for more than half of the year, and the individual can claim the child as a dependent. If all these conditions are satisfied, even if the person is married, they can still qualify for HOH status. Any questions so far?
No, ma'am.
Okay, then Vanna, can you read this example?
Okay. Uh, Hector and Maria are married with one child. Hector moves out of the residence in May. They are not divorced by the end of the year. Maria maintains the household for the remainder of the year and claims the child on her individual tax return. Maria may claim head of household status. Hector would then be required to file as married filing separately.
Yeah, so this is an example. These two people are married. One of them is claiming HOH, the other one is claiming married filed separately. This is not very usual situation, but it's possible. Usually, when they go with married filing separately status, both of them will put MFS status. But if certain conditions are satisfied, then you can even go for HOH status. HOH will always give more benefit in terms of credit, standard deduction, and all when compared to married filing separately status. Okay. Muskan, can you read this 1.4? Yeah, so in this case, they will not file as married filing separately, right? Because they are not married, they are legally separated. So now their status has changed to single. If they were not legally separated under a final decree of separate maintenance, maybe if the divorce proceedings were going on or separation agreement was still under process, then they would go with married filing separate status. Okay, so with this, we have covered all the different filing status. So when you're preparing 1040 on the top of the form, make sure we are filing the correct category for the purpose of status. Some people may be single, some people may have HOH, some people will be filing married filing jointly, some people might be filing separately. So we need to understand, are they satisfying the conditions for, to be able to file into that status that they had elected. Okay. Okay, I think we're done with this. Anyone has any questions, anything here? Otherwise, we'll move on to the standard deduction part. Divyansh, Rohit, you guys are okay?
Yes, ma'am.
Anurag, even you have not attended earlier. Right? So it's first time for you. You able to follow?
Yes, sir.
Okay. Okay, you can be on note. Make sure you're making your notes. At least you're jotting down the important points, because if you write, you'll probably tend to remember them more. Okay. And okay, let's go to the next topic, which is standard deduction. Sorry. Shweta, will you be able to explain what is standard deduction? Are you there?
Yeah, so the standard deduction is a specified amount given by IRS which can be deducted from the total income of a taxpayer, and the balance will be the taxable income. That is what I know.
Yes, perfect. Yeah, very good. So As the name says, standard deduction. This is a deduction which is standard in its amount. It is given by IRS for all different filing status category. It would be a separate amount. It would be a different amount for each status. And what does it do? It will reduce the total income by that much amount, and then it will bring it down to taxable income. So the tax will be levied on the total gross income, okay, less standard deduction, then we come up to taxable income. So standard deduction is a very important part because it can go up to from $10,000 to $12,000. It can go up to $26,000. So if the person is making $100,000, $25,000 will straight away get deducted. So he or she is paying taxes only on 75. That's a big amount. It's not a small number. It could be very big. I mean, it's significantly big number as compared to the total, other areas for an average taxpayer. So it makes a big difference. And these amounts are all calculated automatically when you're doing the tax return on the software. You don't have to go specifically and put in the amount, because the moment you put the correct filing status, the standard deduction will come automatically. Okay, but you need to know what is happening. And there's something called itemized deduction. So standard deduction is something which is given by default by IRS to everybody. Okay, saying that, okay, fine, you are a single person, take $12,000. Whatever your income is, reduce it by 12,000, pay taxes. If you're doing married filing jointly, take it, reduce it by $25,000 straight away, pay taxes on the remaining. But then what is itemized deduction? Itemized deduction is IRS gives that flexibility that if your expenses, certain expenses are above, going above than standard deduction, then you would be able to claim more. With standard deduction, you'll probably claim $25,000, but there are certain expenses which can be considered for calculating itemized category. And if those expenses add up to more than $25,000, then obviously, right, one would want to go for itemized deduction. Because now instead of reducing their income by $25,000, they'll probably be able to reduce by $35,000 or $30,000. That will give more benefit. Itemized deduction is always filled up on Schedule A. So whenever we talk about Schedule A, you should always remember that we're talking about standard deduction or itemized deduction. The question may come, okay, when we're working on 2022 return, we may want to know, okay, what did we do last year? What is there on Schedule A? Immediately it should strike us that, okay, we are talking about standard deduction. Did we go with standard? Did we go with itemized? Now, what is considered to be itemized? That's a separate thing. We will go over that. I mean, I don't want to get into that right now. There is a separate chapter on that. We'll look into it. But what we need to know is standard deduction is the standard amount that IRS give, but quite possible that the taxpayer is also eligible for itemized deduction. In that case, we have to ask right kind of questions to taxpayer in order to make sure that we are not losing on any of the benefits. For example, if the taxpayer is paying mortgage interest on the primary home, that interest is deductible. So maybe for 2022, when we are doing the returns, the taxpayer the client forgot to give us mortgage interest. So this is why if we are reviewing last year tax return and we go on Schedule A and we say, okay, well, you paid like mortgage interest of say $15,000 last year, and this time it's completely missing. We need to be able to ask that question. Why is that happening? Typically, it's like, that's not possible, or it's not very usual that the person has paid off all the loan in 1 year and there is no mortgage interest at all. I mean, it's literally possible, but generally that's not the case. Where were we? Here. Okay, so we need to be able to compare Schedule A's of both the years, and we need to see what's happening. Donations Donation is very important part. Lot of time people will be eligible only for standard deduction, but then they'll come and they'll tell us, hey, I donated $2,000 there. I gave $3,000. I gave $500 to somebody. I want to claim that donation. Donation will always go on Schedule A. There had been certain exception in the last 1 or 2 years where we could have claimed even outside of Schedule A. But then generally, when we are talking about donations, we should know that this is part of itemized deduction. So even if I put 5,000 of donation, 15,000 of mortgage interest, maybe another 2,000 of some other expenses, eligible expenses, it will all come up to what? $22,000. But IRS is giving 25 straight away. Right? So in that case, what would one go for? Sai, what would one go for then? If itemized is 22,000, standard deduction is 25,000, what should the taxpayer elect? Are you there, Sai?
Yes, ma'am. He said mic is not there.
You can come and speak from your laptop.
Yeah, one second.
Yes. What's the answer?
Standard deduction.
Good. Why is it higher?
Standard.
Okay, good. Then there are certain conditions where standard deduction is not allowed, especially for non-resident or people obviously who are itemizing. Why would they go for standard? That's like a quite commonsensical and obvious answer. Non-residents don't get that benefit. Any individual who are filing a short period don't get that benefit. A married person who is filing a separate return will have to go with whatever the other spouse. I mean, both of them have to elect the same thing. If both of them are going with standard deduction, that's fine. But if one is itemizing, then the other also has to itemize. And then there are other kind of taxpayers, those who don't get that benefit. Okay, Sakshi, can you read 1.5?
Yes, ma'am. Gary and Sarah Beers are married but filed separately. Gary has AGI of $40,000 and
And read it
$8,000.
carefully, Sakshi. Read it carefully. You also need to understand because it will probably be asking you a question, not for the sake of reading. Huh?
Okay, ma'am.
Yeah.
Gary and Sarah Beers are married but filed separately. Gary has a AGI of $40,000 and $8,200 of itemized deductions. Sarah has $30,000 of AGI and $17,000 of itemized deductions. Gary and Sarah can elect to take the standard deduction of $12,200 each. If they elect to itemize, Gary will have itemized deductions of $8,200 and Sarah will have itemized deductions of $17,000. If either Gary or Sarah choose to itemize, the other is required to itemize.
Yes. So, okay. So, what is the message from here, Sakshi?
Sorry, I was on mute. For Gary, the standard deduction is provided for $12,200 and itemized deduction is 8,200. So for him, standard deduction is much beneficial,
Hmm.
and for Sarah, itemized deduction is much better because it's 17,000. But if one person opt for itemized, then other person also has to go for itemized deduction.
Why?
Because there is an exception if one person goes for itemized,
But why?
then a standard deduction will not be applicable.
But why? Because they are married filing
Yeah,
separately.
because married
This is
filing.
applicable only for them.
Okay, okay, ma'am.
Okay, they are not legally separated. They're still married, but they choose to file separately. So both of them have to make the same election. Yeah, for for this purpose, what you're saying is right. That 17,000 is more beneficial for Sarah. But for Gary, standard deduction is more beneficial, which is 12,000. Can IRS allow, like, can IRS say that, okay, Gary, you go for 12,200 and Sarah, you go for 17,000? No, they will not allow. They will say that no, both of you, if you were filing jointly, you would have to have only one election, right? Either itemized or standard. So you consider the same situation and do not claim more than what you would have claimed if you were filing jointly. How you break it up between two of you, that's a separate thing. But total should not go higher.
Yeah. Okay, ma'am.
Okay?
Yeah.
Okay. Now let's see what the basic standard deduction. Basic standard deduction, we already saw this. It depends on filing status. And then there is a table below list. Okay, this is the table, which is again, this is about 2019. Don't pay attention to that because, I mean, don't pay attention to these numbers. You don't need to mug them up, the 24,400 and whatever, because these numbers keep changing every year. It's like probably 25,700 or 900 for this year, or 500. I don't remember. But yeah, what we need to understand is that married filing jointly is getting the best possible deduction. Qualifying widower, obviously the status is given only for 2 years. They also get the same benefits. Head of household is the next one in the category, and others are much below, almost like 50% of what the highest category will give. So the taxpayer would always want to stay in one of those top categories where they can get higher deduction. That's why there are certain conditions for head of household. If they're satisfied, then only they will get it. Otherwise, they have to move to single, or they have to move to married filing separately. And $6,000 is a big difference. It could give like a taxable difference of $1,500 to $1,800. Okay. Now there is something called additional deduction. Additional deduction is for people those who are blind or who are above 65 years of age. They get some additional deduction. So, and blind in this context doesn't mean like, like what we would think about. IRS has even given the definition of what they would mean. So, anyone who is not having an eyesight better than this number, or the vision is not as good as what they're prescribing here, then that person could be considered as blind for the purpose of claiming higher standard deduction. In case of audit, obviously they need to be able to prove with their prescriptions and all that, this is what their the eyesight looks like, the vision is. And the other one, if the person has attained 65 years or more, then again they get additional, because that's, maybe you can think of that as a senior citizen, special deduction and all. Okay. And the deduction is not prorated if a person dies or whatever, something happens during the year. For the entire year, the person will get it. Now we will look into this. The basic standard deduction amount of a child under age 19 or a student under age 24 who can be claimed as a dependent. A lot of times we see when we are filing the return that the child is probably 20, 22, 23-year old. They are also having their own income, maybe some internship, some temporary jobs that the person has done. So we always need to make a call. Shall we take that child as a dependent or not? Or does the child is having income more than certain threshold that they have to file their own return? Usually we will still claim them as a dependent because their income, it's not like they're having consistent income for all the education and other purpose. They're still dependent on their parents. But if their income is crossing certain threshold, they may be required to file their own tax return. So now they're giving a limit. When does the child have to file their own tax return? So okay, the basic standard deduction amount is limited to the greater of either $1,100. That's the basic standard deduction amount the child will get, or like who is a student or a dependent and all. or earned income for the year plus 350 up to 12,200. So the earned income might be like internship income or temporary job income and all. That's what is earned income. Unearned income could be dividend, interest, capital gains, or any other passive income. So we have to see if the child is earning much more than 12,200 in earned income, then the child may have to file the own tax return. Or if an unearned income that's making more than 1,100 and all, then again there might be a requirement to file. But generally the rule is if the standard deduction will cover up all your tax amounts, you don't have to file. And what we always advise to the client is whether standard deduction is covering or not, it is better to just file it, have a history with IRS, you know, like have your reportings in order, in just in like, you know, you need to prove it somewhere, or you need to provide the tax returns and all. There is always good to establish a record, even if there is no tax liability. Okay, so we have seen that there are certain examples. Divyansh, do you want to read this 1.6?
Standard deduction, head of household. Tony Mills, 52, qualifies as the head of household. Her basic standard deduction is $18,350. She does not qualify for an additional standard deduction.
Why does not she qualify for additional standard deduction?
Ma'am, because she's not above than 65 years,
Okay,
and she's not blind and her vision is clear.
very nice. Good answer. Next, Rohit, 1.7.
Mike Ford is 68, legally blind and qualifies as a head of household. His basic standard deduction is $18,350. He also qualifies for two additional standard deductions. $3,300, $1650 for being 65 or older plus $1650 for being blind. His total standard deduction is $21,650.
Yeah. So why is that person getting standard additional deduction? Why is it higher?
Ma'am, his age is more than 65 years and legally blind.
Hmm. So 1650 for more than for being 65 and 1650 for being blind and all. And this is head of household category. This is head of household category because he's head of household, and the additional amount that they get is 1650, right? For being 65-year or older, for being blind. So that's why it gets added to the standard deduction. Okay, then is Vinita there? Next. So that's pretty clear, right? Anyone who doesn't understand this? Clear for all? Last one, maybe Honey, you can read 1.9. Why not? Is Johnny satisfying the conditions? Yeah. So that's why. So the mother is 72-year-old, but Yeah, that doesn't mean. And he's getting head of household status because he's supporting mother's expenses. Right. Right. Good. So with this, we have finished this chapter. So now we should all be knowing about the filing status. Any questions here? Siddhabi, are you there?
Yes, ma'am.
Your first time, right, for US
Yeah,
class?
yeah, I am.
You able to follow?
Yes.
But then we'll try to just see whatever we can cover here. So now we have seen all different filing status and all. We'll see filing requirements. Who is supposed to file tax return? Okay, what are the thresholds and all? Now we'll talk about that. Okay, so let's just go through this. An individual must file a federal tax return if gross income is above a threshold. What is it? Any net earning from self-employment, if it's 400 or more. It's very small amount, but still we're talking about the self-employment category. If it's 400 or more, or if she is a dependent with more gross income than the standard deduction. So if he or she is a dependent, we saw in the last chapter that if the person is a dependent, if the person is able to get $12,000 as standard deduction, and if the income is more than $12,000 that person is earning, then he or she should be filing his or her own tax return, even though that person is a dependent on someone else. And we will see a lot of those kind of example with even if with our clients only. Lot of their kids are in colleges and all, they're probably getting some uh, ta and all, or some research, I mean, they're doing some part-time jobs under professors, and also they're getting income, but they're truly, in true sense, they're still dependents, but there may be a requirement to file their own returns, or if they're having unearned income of $1,100 or more. What is unearned income, Divyansh?
Ma'am, interest income,
Only interest?
rent income.
Yes, all passive income, right? Interest, dividend, capital gains, rental, all of that.
Yes, ma'am.
Okay, yeah. Okay, so now generally we will look into what is the standard deduction amount. If the person is earning more than that, they'll have to file tax return. But then there is an exception to that, which is married filing separately category. And there they have put a $5 filing threshold. I mean, this sounds very unbelievable and like ridiculous kind of thing. But again, we clearly, by all the policies that they're coming up with married filing separately, or the reductions in the credits or the benefits, it looks like IRS doesn't want to encourage this category. So they are making it more and more strict, that okay, you don't get the benefits, your threshold is very low, so whether you have income or not, like $5 is nothing, right? You still need to file it and all. The second exception is that, except for married filing separately, okay, yeah, this is fine, that there is an additional standard deduction for over 65 that we can take, but not for being blind. So when we are looking into the threshold limit, well, above the basic standard deduction, we have to see what is the, if they're crossing age of 65 and all, then what is that additional amount that they get, and but we don't have to add up the extra amount for being blind. Okay. Next one is, we do not include social security benefits when we are trying to calculate the gross income, unless they are filing married filing separate returns and live with a spouse anytime, or one half of the social security plus other income and all is more than $25,000. So generally okay, for our sake, we can just put it, generally social security benefits are not considered as taxable. They are not supposed to be counted for this threshold and all. But there are certain situations where we have to see if they're going with married filing separate status, we may have to take that. And I mean, to add it to threshold, still that doesn't mean that it will be taxable. But just to come to that decision whether we should file tax return or not, we need to add up that amount and see if it is crossing the standard deduction amount. Okay, or one half of the social security benefits plus other income and any tax exempt. A lot of this income which is like issued by municipal bonds or government bonds and all, their interest is completely exempt from taxes. But when we are talking about threshold, even though it is not taxable, it's exempt completely. We need to still add up all of that amount to calculate the threshold to be able to decide whether we should file tax return or not. Filing tax return does not mean necessarily you will have a tax liability. But IRS still wants people to file the tax return, not just because they want them to pay the taxes, but they want, if a person is earning above certain amount, they should be filing tax return. So doesn't mean when we are saying that, okay, you have reached the threshold, you have to file tax return. It doesn't mean that we are saying that there will be a tax liability. We just have to go with that IRS rule that there has to be a tax return that needs to be filed. Okay, now then we're going to compute separately whether there will be a tax liability or not. Okay, married filing, again, separately, they're not allowed to include the standard deduction in the threshold computation. Okay, again, they don't get as much benefit as on others because now IRS is saying like, usually you will see what is the threshold, you will take the take the standard deduction, reduce it and all and see if you're supposed to file. But married filing separately, you don't need to do, you're not supposed to do that. Why? Because the other person may itemize, the other person may standardize, we don't know. So they're just saying that just don't take it. And we have already seen this additional standard deduction above age 65, we have to add this amount. But here the difference is for threshold, they are not considering the additional standard deduction for blind person. And when we are in doubt, when we really don't know whether we should be filing tax return or not, it's always safe to go ahead and file it. That's much better rather than to take a risk and not file it. If we are 100% confident that we are following the rule, the income is below the threshold, we don't have to file it, then it's fine. But in the case of doubt and all, or maybe it's very close, then maybe it's better to just go ahead and file it with IRS. Any personal residence gain. So there is a tax benefit that IRS gives that if you are disposing of your personal residence, then you may get up to $500,000 of exemption from the income. So like if your gains are up to $500,000 when you're selling off the house, you don't have to put that up as a taxable income.